The year is 2025. The world has seen significant changes over the past few years, and the economic landscape is no exception. From technological advancements to geopolitical shifts, the factors influencing the global economy are more complex than ever. The U.S. economy stands at a crossroads. On one hand, there are signs of robust growth driven by innovation and consumer spending. On the other hand, there are warning signs that suggest a potential downturn. Rising inflation, supply chain disruptions, and geopolitical tensions are just a few of the challenges that could tip the scales. Will it continue its growth trajectory? Or will it succumb to the looming threat of a recession? These questions are on the minds of economists, policymakers, and investors alike. The stock market, often seen as a barometer of economic health, has shown signs of volatility, reflecting the uncertainty that permeates the current climate. Investors are asking a crucial question: how do we prepare for what lies ahead? The strategies that worked in the past may not be as effective in this new environment. Diversification, risk management, and staying informed are more important than ever. While no one can predict the future with certainty, understanding the current economic landscape and potential risks is paramount. Economists and financial experts are closely monitoring key indicators such as employment rates, consumer confidence, and global trade patterns to provide insights and guidance. This essay serves as a guide to help investors navigate the uncertainties of 2025 and safeguard their financial well-being. By staying informed and being proactive, investors can make decisions that protect their assets and even find opportunities for growth. The possibility of a recession is a serious concern for investors. Historical data shows that economic downturns can lead to significant losses in investment portfolios. However, history also shows that markets eventually recover, and those who are prepared can weather the storm. Economic downturns can significantly impact investment portfolios. It's crucial to have a well-thought-out plan that includes a mix of asset classes, such as stocks, bonds, and real estate, to mitigate risks. Regularly reviewing and adjusting this plan in response to changing conditions can help maintain financial stability. However, with careful planning and a proactive approach, investors can mitigate risks. This includes setting aside an emergency fund, reducing debt, and considering alternative investments that may perform well during a recession. They can even capitalize on opportunities that arise during turbulent times. For example, market downturns can present buying opportunities for undervalued assets. Investors who are prepared and have liquidity can take advantage of these opportunities to enhance their portfolios. Knowledge is power, and understanding the economic forces at play is the first step toward making informed investment decisions. By staying educated and vigilant, investors can navigate the complexities of the 2025 economic landscape and position themselves for long-term success. The U.S. economy has shown resilience in recent years, bouncing back from the challenges posed by the pandemic and other global disruptions. This resilience is evident in the steady growth of the GDP and the recovery of various sectors, including technology, healthcare, and manufacturing. However, some indicators suggest potential vulnerabilities. The stock market has experienced significant volatility, reflecting investor concerns about future economic stability. Business leaders are also cautious as they navigate an uncertain landscape marked by fluctuating demand and supply chain disruptions. Inflation, although moderating, remains a concern. Over the past 5 years, the inflation rate has seen significant ups and downs, impacting the cost of living for many Americans. While recent measures have helped to stabilize prices, the long-term effects of inflation are still being felt across various sectors. The Federal Reserve's aggressive interest rate hikes, aimed at curbing inflation, have raised borrowing costs. These hikes are part of a broader strategy to control inflation and stabilize the economy, but they also come with their own set of challenges. Higher interest rates can lead to increased costs for businesses and consumers, potentially slowing down economic activity. This could potentially slow down economic growth. The construction industry, for example, has seen a slowdown in new projects due to higher borrowing costs. Similarly, small businesses are finding it harder to secure loans, which could impact their ability to expand and hire new employees. The labor market remains strong, with low unemployment rates. Despite these challenges, The job market has shown remarkable resilience. Unemployment rates are at historic lows, and job creation continues to be robust across various sectors. Consumer spending, a key driver of economic growth, has remained relatively robust. Retail sales have been strong, and consumer confidence is high. People are spending on a wide range of goods and services, from everyday essentials to luxury items, contributing to overall economic growth. However, rising interest rates and persistent inflation are putting pressure on household budgets. Many families are finding it harder to make ends meet, as the cost of living continues to rise. This financial strain is leading to changes in spending habits, with more people cutting back on non-essential purchases. This could lead to a slowdown in spending in the coming months. If consumer spending decreases, it could have a ripple effect on the broader economy, affecting everything from retail sales to manufacturing output. The global economic outlook also presents uncertainties, with geopolitical tensions and supply chain disruptions posing potential risks to U.S. growth. International trade has been affected by these issues, leading to delays and shortages of various goods. As the world navigates these challenges, the U.S. economy must remain adaptable and resilient to sustain its growth trajectory. Inflation has been a persistent challenge for the U.S. economy. While it has shown signs of easing, it remains above the Federal Reserve's target rate. Investors need to be prepared for continued inflationary pressures in 2025. High inflation erodes the purchasing power of money. This impacts both consumers and investors. Assets such as cash and fixed-income securities lose value over time when inflation is high. Investors need to consider inflation when making investment decisions. They should look for assets that have the potential to outpace inflation. The Federal Reserve plays a crucial role in maintaining economic stability. Its monetary policy decisions, particularly interest rate adjustments, have a significant impact on the financial markets. In 2025, the Fed faces the delicate task of controlling inflation without triggering a recession. The Fed's aggressive interest rate hikes in recent quarters have slowed down inflation. However, they have also raised concerns about an economic slowdown. Investors will be closely watching the Fed's actions in the coming months. Any indication of a policy misstep could lead to market volatility. The financial markets are constantly evolving, presenting both opportunities and risks for investors. In 2025, several key risks warrant attention. Understanding these risks is essential for making informed investment decisions. Inflation remains a top concern. If inflation remains persistent, it could lead to further interest rate hikes by the Fed. This could potentially dampen economic growth. Geopolitical tensions and supply chain disruptions also pose risks to the global economy. These factors could contribute to market volatility and uncertainty. In times of economic uncertainty, diversification becomes paramount. Diversifying your portfolio across different asset classes is crucial to mitigating risk. Don't put all your eggs in one basket. Spreading your investments across various asset classes can help cushion your portfolio from market downturns. Different asset classes tend to perform differently under different economic conditions. Diversification helps reduce the impact of any single asset class on your overall portfolio. During economic slowdowns, certain sectors tend to be more resilient than others. Defensive sectors, such as consumer staples, healthcare, and utilities, are less sensitive to economic cycles. Consumer staples companies provide essential goods and services that people need regardless of the economic climate. Healthcare is another defensive sector, as people require medical care in good times and bad. Utilities provide essential services such as electricity and gas, which are less affected by economic downturns. Bonds are often considered a safe haven asset class during periods of economic uncertainty. They tend to be less volatile than stocks and can provide a steady and reliable stream of income. When stock markets decline, bonds can provide much-needed stability to your investment portfolio. Government bonds, particularly U.S. Treasury bonds, are considered among the safest investments available. Corporate bonds offer higher yields, but also carry higher credit risk compared to government bonds. Maintaining adequate cash reserves is crucial, especially during times of economic uncertainty. Cash provides liquidity and flexibility to take advantage of market opportunities. Having cash on hand allows you to invest in assets when prices are down. It also provides a financial cushion to cover expenses in case of income loss. Aim to have at least 3 to 6 months' worth of living expenses in a readily accessible account. Investors should pay close attention to key market signals that can provide insights into the health of the economy and potential risks. These signals can help investors make informed decisions and navigate the complexities of the financial markets. Understanding these indicators can be the difference between capitalizing on opportunities and suffering losses. The S&P 500 index is a widely followed benchmark for the U.S. stock market. It represents the performance of 500 of the largest companies listed on stock exchanges in the United States. When the S&P 500 is performing well, it generally indicates a healthy economy and strong corporate earnings. Conversely, a decline in the S&P 500 can signal economic troubles ahead. A decline in the S&P 500 can be a leading indicator of an economic slowdown. Investors often look at trends over time to gauge market sentiment and potential future movements. A sustained downward trend might prompt investors to reassess their portfolios and consider more defensive investment strategies. The New York Fed's recession probability model is another valuable tool. This model uses a range of economic data, including interest rates and employment figures, to estimate the likelihood of a recession in the near future. By analyzing these probabilities, investors can better prepare for potential economic downturns. It uses economic data to estimate the likelihood of a recession in the near future. This model has been historically accurate in predicting recessions, making it a critical tool for investors who want to stay ahead of the curve. By keeping an eye on this model, investors can make more informed decisions about their portfolios. By monitoring these and other market signals, investors can gain valuable insights and adjust their investment strategies accordingly. Staying informed about market trends and economic indicators allows investors to be proactive rather than reactive. This proactive approach can help mitigate risks and capitalize on potential opportunities, ultimately leading to more successful investment outcomes.